My next guest served at the People's Bank of China, is also former Deputy Managing Director of the International Monetary Fund. Zhu Min, welcome to Bloomberg Surveillance. First of all, how do you see the Chinese actually delivering on their part of the trade deal with the U.S.?
Well, the trade deal actually is quite good for China's side because you think about China imports, right? And because China need to import those things, the soybeans, all those things, and energy, those things. And particularly on the structural reform side, opening financial market, protect the IP, improve the business environment. It's all things China need. I think this is very important. China is moving from roughly $10,000 per capita middle income to $15,000 per capita high income categories in the next few years. I think international experience tell us in this particular moments, open door, bring the international competition, improve the business environment. This is the key issue for China. So I think this deal is very much from China's own interests.
Does the world and does the Western world understand what kind of form Chinese capitalism will look like in 10, 15 years?
Well, in 10, 15 years, I mean, if you're looking for the cultural history, China being the central bank for 5,000 years, so collective activities is really a big issue, it's more centralized in the 5,000 years. So China may have a different form, but obviously a market-based run the economy, so bring the people better life is really the key objective for all the Chinese.
We've seen a number of defaults in China. Is that a good or a bad thing? Is it letting steam out, or can it be something more sinister?
What defaults you mentioned?
Some of the defaults in some of the smaller brokerage companies. There seems to be companies actually come out with defaults.
No, I think those are good things.
Are good things.
Because that's exactly let the market play the role. I mean, think about China have a pretty high debt and over leverage is still a concern. So let those small companies go defaults, and I think this is a good thing because it's in a world getting the whole system a little bit more healthy. You will continue to see those things happen. I think that's a good. The market should play a role. The state should not protect them. Make sure those guys can live forever.
So, if you also look at the opening of the financial sector to foreigners in China, do you think that will be quicker than we think, or actually slower?
I think it will be quicker than you thought. I mean, you see, UBS is here, JP Morgan is here, S&P is there, Pepper is there, Bridgewater is there, JP Morgan is there, BlackRock is there. Everyone's there. I mean, one thing is amazing today, foreign capital account more than 10% of the Chinese equity market trading volume today. This is incredible from 2% just 12 months ago. So I think because the market is big, all the foreign financial institutions is really moving, but it will take some time for them to get used to the local environment, the market, and the regulatory framework.
So do you think that trend will continue from what we saw last year? Is this just going to open up more and more and more?
In my personal experience, because I see more of my friends come to see me. Try to see how the market will be and what will be the business opportunity for them.
So what do they ask you?
The key issue is how do you do the business in China? How really the openness is real, and what about the regulatory framework, and what is the cost? So I think those are all very interesting strategic issues for business. But I think most of the people feel the Chinese financial market is such a big market, they cannot just miss it. The only thing is they made their internal strategy. I told them, the ball is not in China, it's in your ballroom. Because China is so big. If you want to do business in China, the key issue is the scale. If you want to play big, do move to China, but you have to get approved from your board. So the ball is not in China, it's in your side.
So what happens when you look at the U.S.-China Phase 1 deal? Are we actually going to see a Phase 2 this year? Or could both countries live without a Phase 2 deal?
I think a Phase 1 deal is good. I mean, focus on trade. I think that's one thing. Reduce the tension is most important, but also have a very broad coverage, touch many things from IP, technology transfer, IP protections, environment, and the business, the environment improvements, all those things, right? So I think it's good for both sides. We'll continue the dialogue. I will prefer to have a more broad sort of economic dialogue rather than narrow defined trade. Because being number one, number two biggest economy in the world, these two countries have to talk, and have to talk in a very broad way. So I very much expect to see a trade economic dialogue.
Zhimin, there's a number of questions, of course, about trade, which we'll get to in a second. But how would you describe the world economy right now? We had a recession scare last year. Has that now gone away?
I think with the trade deal, people are much more relaxed, right? I think it will bring global growth roughly 0.2, 0.3% back. Although growth remains low, I think last year is 2.9. This year is probably will be around 3 to 3.1. Still in the low boundary, I think that's one thing. And the liquidity is still ample, right? In the last year, I mean, more than 40 central banks cut more than 70 interest rates. We're once again in a cutting move, right? So liquidity ample. I think the market should be okay. Although everybody understand the equity market is way high, we are all at the end of cycle in financial market and in business cycle, but the appetite is still there. So I think 2020 should be okay, yeah, economically and financially.
But have central banks done too much so that it doesn't force countries to spend?
Right.
Are we relying too much on central banks?
We're relying very much on central banks, that's for sure. Yeah. The central bank once again become the only game in the town. Yeah. But given the very particular situations, you have very low inflation rates, you have a low and growth rates, right? And you have a limited fiscal space. Monetary policy is still the way to keep the growth, to make the economy run, right? So in that sense, I think the central bank is doing their best. But we really need to figure out how we can get out this liquidity trap, how the bank and the physical policy can work together in the near future. So I very much hope this Davos meeting will be able to bring the central bank and the Ministry of Finance sit down to talk about.
So talk to me about PBOC. How's it changed since you left?
Well, PBOC changed a lot. We move more to the market-based exchange rate. I think that's more important things, and we also liberalize further the interest rates. Now, interest is very much market-based, which is also important. We bring, because of that, we'll be able to build on the hedge market. Another thing, the central bank is very tough on P2P, which created a lot of problems, and also deleveraging process was tough in the past 2 years. But now we move to stabilize leveraging, because if you deleverage too strong, too fast, you can create a problem. So I think stabilizing leveraging, it's a proper policy today. So I think the financial sector, actually, risk is just coming down size, and things are getting better.
Should we worry about shadow banking in China, or was this a problem of...
No, I think shadow bank is gone. I think 3 years ago, shadow bank is a real concern because, and there's off-balance activities on the wealth management, the money goes nowhere. P2P is really everywhere, right? So it was really tough since 2017 to try to bring those off-balance assets back to the banking assets and try to close these P2Ps. I think today, shadow banking is really not the key issue. The key issue is a monetary policy transmission mechanism, make sure the liquidity move to the real sector.